It's Pat Dwyer and Greg Pool again from NewEdge Wealth, our multifamily office here today. And we're here today to talk about borrowing against your alternative investments. Today with us is Mike Roffler, the former CEO of First Republic Bank. Welcome. And Alex Simpson, the founder of Liquid LP. As you all know, at our firm, we do not take a scrape of any of the investments. And when our clients come to us looking for solutions, we go out in the marketplace and try to find the best-in-class provider. In this case, how we came across Liquid LP was they were a referral from us from Arch, which is sort of a state-of-the-art fintech platform that organizes your alternative investments in one place, no matter where you bought them. So Greg and I have been dealing with this issue quite a bit, where we have clients who have liquidity needs. And I'll turn it over to you, Greg, who has a background. Greg's background, to remind you all, is Greg worked at Wellington for 23 years. He was a partner there and ran alternative investments. He ran a hedge fund, knows the space from the kind of the ground up. And we'll kind of start with like what's happening in the space, Greg.
Yeah, thanks. And welcome, guys. We're excited to talk to you. Obviously the world of the private landscape has been changing, in recent years to I'd say detriment in many few ways of the investor, where, liquidity has been very, very hard to come by. And, what that has meant is that, a lot of investors' portfolios are a bit offsides from an asset allocation standpoint. And we've seen that, clearly happening at the institutions. Many people have seen Texas teachers just announced they're going to be reducing their private equity allocation going forward to try to get that more into balance. But that's also the case with many individuals as well, because their private accounts, their private equity allocation in particular, have just remained very high. And so one of the ways, as Pat said, we're in the business of trying to solve problems for families. And one of those is, how do we get liquidity? And we're out there, as Pat said, we don't really have an agenda. We're just trying to find the best solution. I would say if we go back in time, looking at secondary markets for LP stakes was something that we considered. That's really gotten quite unattractive. We have a number of people that we talk to and we get bids for clients, and those have gotten to be pretty penal. We often see 30% discounts for good funds and 50% for funds that only look okay. And that's probably not a great solution today. And so one of the things that we've gotten much more interested in learning about is lending against private portfolios. And that's a topic we think, would be great to learn more about. And so that's what we've brought these folks here today to help educate us on.
Yeah, we have two of the best people in the world here. So let's start with this. So if you are a ultra high net worth client, of which there are a lot of today, and you have a very significant portfolio of alts that hasn't paid you any real capital out in 4 years, and maybe you move this into a trust, and you didn't anticipate that the trust would need liquidity, but it does, because you didn't get any money out of these funds like it normally would. And, nothing has changed yet. Really describe to us, to start off with, the landscape for an ultra high net worth client who wants to borrow against their alternative investments. Like, what are their choices?
Thanks, Greg and Pat. It's great to be here with you. And I think, Greg, you said it right. If you think about private equity and venture, the allocations over the last decade have grown dramatically. And if I think back to our legacy business, it was a huge differentiator to be able to offer this to ultra high net worth clients. And, then you sort of, as you mentioned, we've had this liquidity just complete dry up. And so you're getting no distributions. You're also getting presented pretty good opportunities for new funds, or, when things are like this, many of your best investments will be made right now, but the liquidity is just scarce. And so when Liquid LP, the premise really came about was, the two co-founders, Alex Simpson now and Bryant, in talking with so many funds, this topic continued to come up because general partners are getting a lot of pressure from their investors. Where's the liquidity? Why is it not being distributed? Like, what's going on? And you're right, the alternatives were not great. Secondary market. Why are there so many secondary funds right now? because the economics are very attractive, right? You're buying high quality, great assets at very much discounted prices. And so the business really came about, and other shops do this. Well, what if we had a very diversified group of investments and we lent against it? If you're lending at even 10% plus, that's still dramatically better than some of the haircuts you're taking in the secondary space. And you're not incurring tax obligations, right? Because you liquidate, you probably have a built up tax gain. Well, you need more cash to pay the taxes. And so we really thought that lending against these assets was a business that, was a little bit non-traditional, because the banks are very much, real estate lenders, credit card, autos. It's an asset class they really don't participate in. And we've had the opportunity to probably speak to 50 banks. They love the idea, but they all know it'll never get through their internal processes. And so it's really it's a one-by-one client, though, where we can really be attentive to what the client need is and what they're trying to accomplish.
So Alex, like we've already engaged you on some things, but I mean, you sort of describe the process. Somebody brings a portfolio to you. What's the turnaround time first? Because speed matters, right? Banks will take 6 months to make a decision. How quickly can you come back and say, all right, this is what we'll do? What's that turnaround time look like?
Sure. So it's very contingent on the readiness of the documents, on the fund documents. So once we have that and we can understand a good overview of the borrower's financial position, it usually takes us max within 2 weeks to give official terms and to end the process in 3. The areas that take usually longer is, of course, attaining all the documents, attaining certain consents from the respective funds, and then any sort of legal nuances, especially with trusts. We need to make sure that we have all those in place. But yeah, I'd say 2 to 3 weeks is the estimate, aside from having those different variables in place. But that's why working with wealth managers is really important, as they understand the clients best, and that can really help with the communication and management of expectations with the client, and also attaining all the documents in place beforehand.
And in terms of like what type of structure the loan takes, is it flexible, or can it be floating? Is it fixed? Is it term? How does it typically work?
So it's based on SOFR. So that's how we base our rates. We usually structure it with an origination fee and then a SOFR plus base rates. We can do, from a structural perspective, 6 months past 3 years. And our average loan size now is roughly about $12 million for an 18-month tenor. But we work with the clients. It's a very ad hoc basis. It's depending on when they need it. We have put revolvers in place for particular clients as well. So it's really dependent on the client's needs, which we really come forward with.
Yeah, we like to think we can be flexible in listening, just like you guys when you serve clients, right? You want to listen to what the client's trying to accomplish and see if the structure makes sense based on what they're trying to achieve. I mean, Alex mentioned a revolver. I think in this case, the client, had scheduled cash capital calls or needs over a 12 to 18 month period. So we put the line in place and then they draw down sort of as needed. And we have others that are fully dispersed at origination for a 2 to 3 year term. But it's really meant to be that dialogue with the client of what's the need, what's the amount, and importantly, what are the liquidity events that will be coming? If you think about where we started this conversation, we're in the desert right now for liquidity. When are we going to get to water? And there's liquidity. I mean, you guys do this every day. I don't think it's this year, and I'm not sure it's next year.
Yeah, that's a concern that I share. As I was looking through like the last 5 years of returns. It's not an index, just like broadly across, a lot of what we have in our system. And it's just remarkable how little capital has come out of these funds since 2021. 2021, there was a huge markup, and it's been flat since. And everyone's like, next year is the year. I'm like, well, what if it isn't? Like, What if it isn't next year? And so that's going to be a real challenge for some people's balance sheets. And obviously, looking at this asset class. So why would someone, assuming that we're talking about a very wealthy person, right? They have a big liquid portfolio and they have an illiquid portfolio. I mean, I think I know the answer, but people trying to isolate this particular capital and borrow against it because they look at it as a different risk profile and they want to keep their liquid stuff clean. Is that predominantly because you're looking at their whole balance sheet to see how much they're levered?
Yeah,
I'm assuming you guys are not.
right. That's right. Like we're putting leverage against the private portfolio, and you may use your public portfolio, and maybe they're pledging that for other reasons. But if you think about like they're able to keep control and ownership of the private assets, they're able to then reflect the upside when that comes in the future, ideally. And it really is sort of becomes a pocket of your balance sheet that you can look at and say, I'm leveraging at 20%, some amount, and that allows me maybe future investments when Fund 6 comes after Fund 5 has been so successful. Maybe I have a tax obligation that because we're in the desert, I'm not getting any liquidity. I need to take care of that because, as you all know, the IRS, they always collect. And so those things happen. And because the traditional space, like if you want to margin your public portfolio, the bank is the place to do that, without a doubt. The bank will do that because that's something they understand very well.
If you're sitting, put yourself in one of our clients, shoes, and they're starting out on this process. What are some things, I think they should be aware of? What are the different, considerations as they look across the landscape? And I guess, is there anything that's, you think, surprising or not obvious that, you guys think about in your business that they should be aware of?
So I think also from our perspective, of course, not giving any sort of financial advice, but just to give like disclaimers in place, of course, understanding the full use of their proceeds and what they need for it, and the timing from a cash flow perspective is really important. We've had clients in the past that have under asked or sometimes over asked in terms of the loan amount. And even though we want to lend more, we need to make sure that, do you really need it at this time? So we've had clients in the past where they've had certain obligations, but they don't need to pay each obligation at the same time. So if they were to incur the full amount, they'd be incurring more interest. So that's also why working with RIAs is helpful, so they can really explain to the client from a cash flow perspective. Also just understanding the financial position of a borrower. Like we aren't able to just lend purely off the collateral of fund positions. We need to make sure the borrower has other collateral that they're happy to put as collateral in the event that these funds don't meet the minimum requirements, regardless from a cash flow perspective. Then they need to make sure there's other collateral in place. So I'd say those are the two of the big things that we've had from our experience, and just to explain to them the full extent of terms. Mike, I'm not sure if there's anything from your side that you want to mention.
Yeah, I think the best we've seen, and as you guys are advisors and your teams, is to have that discussion with the client, and this provides optionality, right? Is we're meant to be another source of consideration if you think of an overall basket of options. It's not meant to be the only source, and maybe ultimately you need to liquidate and you want to use the secondary. That's great, but don't use that as your only option either, because that won't lead to the best outcome.
No, it definitely will not, because the spreads have really widened over the last 4 years, because we were advising clients when the rates went up to sell, and it's gotten more and more challenging to sell. In terms of like advance rates, and you don't have to give away any trade secrets here, but like what's the difference between like a tier one fund that's like full, not calling any more capital, you're just waiting for the money to come out, and like sort of an average fund in the same position? They're kind of mostly done calling capital, and what kind of.
So we typically like that the funds are later in their capital call life. It doesn't mean we have done things that are not at the end. Most we'll talk about historical transactions, have sort of been in the 20 to 25% leverage of the current capital statements, let's call it. And that feels comfortable to us. And typically, I think every deal has been recourse. So there is personal, and it's not as if we expect to have to exercise recourse, but we want everyone invested. Alex and team, they have a list of, names of firms that we would be able to decide quickly on versus firms that might be not as well known that we got to do a bit more work. I'd say typically the individual sort of gives the guarantee. It doesn't mean we're going to go put mortgages on their houses, things like that. We do get sort of consent for the limited partnership investments as specific collateral, but the rest is more of they've guaranteed the obligation, which gives us the ability to, God forbid, if we had to do more work and go after other things, we would.
I'd like to ask you just briefly, like industry trends, like do you see private lenders such as yourself, highly specialized, dealing with ultra high net worth individuals? Is that going to be a growing segment in the marketplace, in your opinion, Mike and Alex?
Certainly, yeah. We've seen the trend come across quite naturally, and sort of just the optionality of liquidity options that's been asked a lot. There's a lot of people that haven't heard of this type of offering, but we've seen the adoption slowly coming through. We've also seen how Goldman Sachs have offered this through a lot of their RIA channels as well, as they know their clients very well. So we're seeing there's a big adoption towards this sort of offering, and we'd like more adoption of this with other lenders. We think that there's a big market to service.
I think a private credit group maybe a week ago, there's been this transition that has occurred somewhat organically over the last few years where the private credit markets are just expanding depending on asset class. And this is an asset class that just has not been developed. And so just like other asset classes that have been developed in the private space, I think you're seeing this and are going to continue to see it, because right now, the traditional lenders are challenged with, I'll call it uncertainty of what are the capital rules going to be, what are the liquidity rules going to be, which makes them hard to develop, things that aren't tried and true, and to go outside of the box. And I think I mentioned earlier, like we've probably talked to 50 banks who think it's a terrific idea and a terrific space and can be done very safely, but it's just not something that with this uncertainty that exists and sort of the challenging banking market, they're gonna dip their toe in right now.
And this is what we live for. We live for kind of emerging technology and emerging financial technology that can help provide the best solutions for the clients, and you often find that these days outside of those traditional channels. What you guys are doing about the space in general, this has obviously been very, very helpful.
Yeah, look, I think as giving clients optionality all the time and just education is key, whether it's from a lending perspective, outright liquidity. I think we're just finding that the more educated the space gets, the better. There's no forcing of terms or structure. I think just education around like liquidity and options, and is it truly needed? That's really key, and not to just take out credit for the sake of it. To really understand what's the use, what's the potential ROI here, and also will it relieve a lot of stress as well? That's also critical. So yeah, I think that's great.
I just want to say, Alex, you and your partner have been really a pleasure to work with, extremely professional and as knowledgeable as any sophisticated lending person I've ever dealt with, and I've dealt with a lot of them. So I appreciate your professionalism, and I love the innovation. And I think that the future of lending is going to be niche lenders who provide very specific services for clients who have very specific needs.